everybody, today we are going to look at the accounting equation. Now, analyzing transactions on the accounting equation means that we have to look at the effect that the transaction has on assets and then owner's equity and liabilities, because the equation says assets equals owner's equity plus liabilities. So we're going to still use the steps of analyzing a transaction like we've done in the previous. So just a quick recap. 1. We identify the two accounts by asking ourselves a few questions. First of all, is this a cash, a credit, or a return transaction? So if it's cash, it will be bank. If it's a credit transaction, it can either be a sales transaction or a purchase transaction. So with credit sales, it will be debtors, and with credit purchases, it will be creditors. And then returns is either by the debtors or to the creditors. So debtors allowances, or DAJ, is sales return, and CAJ is a purchase return. But that will be discussed in a next chapter. So we are going to classify the accounts then as an asset, owner's equity, or a liability. We're going to follow the flow, plus or minus, according to what happened for the business. And then we're going to look at debt click to decide debit or credit. So therefore, expenses, assets, and drawings will debit or plus on the debit side. And liabilities, income, and capital will credit or plus on the credit side. So if we have to look at a transaction analysis, we look at activity 3.1.4. They say use the same transactions as number 3.1.3 that we did the analyzing of transactions, and now analyze it according to the equation. The first number A has been given to you as an example. So how did they get to this answer at the bottom? We have to now follow the steps again. So 1, the owner gave capital to the business and into our account. So bank is the other account. Now capital is owner's equity and bank is a current asset. Capital, the flow of the money will always be according to the business viewpoint. So capital increased for the business, but our money also increased in our account, the business account. So whenever you analyze that transaction, it will always be from the business viewpoint. And then debt click, which one of these accounts must now be debited or credited? So if we look at our debt click, we can see that capital is the credit account and bank is the debit account. And that is how they now use their 4 steps to fill in the table. Account debited was bank current asset. Account credited was a capital owner's equity. Assets plus with 400,000 and equity plus with 400,000. And our equation still balances out. And we know we've done the transaction correctly. So now we're going to look at transaction number B, where they say, okay, we have the loan application at Fellow Finances and was successful, and they transferred the 200,000 into the current bank account of the business. So the two accounts is loan, because we borrowed money, and where did we put this money? In the bank. Now, loan is a non-current liability and bank is a current asset. For the business, we owe more money because we made a loan, and our bank account will plus because they actually transferred the money, the cash of that loan into our bank account. And then quick debt click, and we know loan is the credit account and bank is the debit account. And if we look at the answer at the bottom here, bank current asset was the debit account, loan non-current liability was the credit account. Always important, please put the name of the institution next to the loan, because you can have many different loans. Asset plus 200,000 Rand because of the cash inflow, but now our debt also increased because I'm going to have to in future pay back that 200,000 Rand. The equation still works out because both sides of the equation increased. Now we look at transaction number C, where we withdrew 8,000 Rand at the ATM with a business debit card to pay the weekly wages for 4 employees. Please note, the ATM withdrawal was 8,000 Rand. So 4 employees didn't get 8,000 each. All of them received as a total 4,000 Rand. So the 2 accounts we identify is we paid wages. ATM will be the bank account that's influenced. Step 2, we have to classify. Wages is an expense, bank is an asset. Now, expenses increased because we are paying more wages to our employees. Our bank decreased because we are losing cash. So account debited is wages, account credited is bank according to debt click. But now we don't have. How does expenses now fall into our equation if no expense is listed in the equation? So we can now say, okay, but owner's equity is the owner starts the business to make a profit. The definition of profit is income minus expenses. So expenses is a subclassification of equity. And now we said, okay, but the expense plus. So what does this increase in expense affect equity? So a plus in expense has a negative effect on equity because it minuses profit. Therefore, an increase in an expense is a negative owner's equity. The higher the expense, the lower your profit will be in the future. So therefore, if we look at the answer, we have wages, account debited, expense, and account credited, bank. Bank, the money is minusing, that's straightforward. But then this minus here for equity links to the plus for expense. But why do we now say minus? Because we don't want the effect of the equity. And equity is profit. What happened to our profit? That minused. So therefore I put a minus there instead of a plus. Then we are going to look at transaction number D, which actually has 2 parts. It says cash sales for the week according to the cash register roll amounted to 25,000 Rand. And the cost of these goods was 12,500 Rand. So 2 parts to the sales transaction would be sales, which can be either cash or credit. In this case, it was cash. And the cost of the goods sold. So if I now look at the cash sales of 25,000 Rand, we identify the 2 accounts for this part of the transaction first. And that will be sales and bank. Sales is an income, bank is a current asset. So income plus and assets plus. Therefore, sales is the credit transaction and bank is the debit transaction. Now the second part of the transaction, the cost of the goods sold. So cost refers to the cost of sales and goods refers to trading inventory or trading stock. Now, cost of sales is an expense and trading inventory or trading stock is a current asset. The expenses increased and the trading stock decreased because we sold the stock and therefore the expense increased because I have to replace the stock in the future. So the account debited will be cost of sales and the account credited will be trading stock. So that is why we have 2 parts to this answer. 1, the sales, the cash part, bank increased because we had a sale, increased with the selling price 25,000 and the selling price 25,000. And second of all, our expense, remember expenses, the higher the expense, the lower your profit. So it has a negative effect on equity. And our trading stock asset is gone out the door with our customer, therefore minusing. So guys, remember that practice makes perfect. So go and practice the rest of this activity and make sure that you can understand this and analyze any transaction for the future. And this will always be part of any exam or mostly test questions to test the basic knowledge of your accounting. So Good luck, and remember, practice makes perfect.